Hey guys, so today we're going to talk very basically about what an index is as related to the stock market. And this is important to know if you're looking into investing in index funds, mutual funds, or ETFs, because an index is what is at the core of all three of those. So an index is basically just an average of a group of stocks, and people use those indexes or indices as a way to compare how different sections of the stock market or how the stock market as a whole is doing. There are a few indexes that you have probably heard of before. There's the S&P 500, the NASDAQ, and the Dow Jones. Those are probably the three most popular ones, but there are about 5,000 indexes in the US market. So we'll talk a little bit about what those three indexes mean. The Dow Jones is the oldest index that there is. It takes 30 of the largest stocks on the New York Stock Exchange and it averages those. Back in the day, this was a really good way to get a feel for how the whole US stock market was doing, but now we have the S&P 500 for that. So the S&P 500, instead of just having 30 stocks, is the average of 500 of the largest stocks in the US, which is why now that has become considered a better indicator of how the overall stock market is doing. The S&P 500 index is usually what people are talking about when they say that the stock market has gone up or that it's gone down. And it's also measured in points. So if you've ever heard someone say the market is up 200 points or the market is up 50 points, that is what they are referring to, is the S&P 500 index. Then we have the NASDAQ, which is made up of about 3,000 stocks. So why, if this one has more stocks in it, is this not used as the standard? It's because historically, NASDAQ has been a very tech-heavy index, meaning that a very large portion of that index is made up of tech companies. So even though it isn't solely tech stocks, it still is a better indicator of how the tech sector is doing versus the entire stock market as a whole. What we have to understand about the way that these index averages are calculated is that with the S&P 500, for example, it isn't necessarily that there are exactly 500 stocks, you add them up and you divide by 500, and that's the average that we're seeing. Different indexes have different ways that they weight their averages, meaning that certain stocks will have a greater impact on the index than others. So for example, in a weighted index, if you have one company that is worth billions and billions of dollars and it's like the number 1 or 2 biggest stock, but you also have a small company that just barely made it into the index, if it's weighted, that bigger stock is going to influence the overall movement just a little bit more than that tiny stock because it makes up a bigger percentage. So a question that a lot of people ask when they're first starting out or when they're first hearing about the stock market is, how do you invest in the S&P 500? And the short answer is you can't invest in the S&P 500 itself. All an index is an average that a company is publishing. So you can't actually invest in the index itself, but you can invest in index funds. So these usually take the form of just index funds, of mutual funds, or of ETFs, which are exchange traded funds. If you want to know what the differences are between those, be sure to subscribe because that is the next video, but I will try to briefly explain what these index funds are for. So index funds are meant to mirror an index, meaning that the price of the index fund will move up and down along with the average of that index. A couple real examples of this are the Vanguard 500 Index Fund, which is ticker symbol VFINX, and the Vanguard S&P 500 ETF, which is ticker symbol VOO or VOO. So the purpose of these is that instead of having to go and buy an individual share or fractional shares of every single company in the S&P 500, you can just go and buy one share of this ETF, so we'll use VOO as the example. And once you buy into that ETF or an index fund, you then own a tiny little fraction of all of those companies. So what a lot of people like to compare it to is that an ETF or an index fund is like a basket. And in this basket, you'll have a bunch of tiny little pieces of the stocks that are in that index. So for example, with VU, the largest holding, meaning that the company that they own the most shares of, is Apple. So in your share of VU, you probably have a piece of Apple in there. Now there's something important to understand about this. We can buy and sell this basket, which is the ETF, or in this case, VU. What we can't do is remove anything individually from the basket. We can't pick and choose. This is important to know because, for example, if you bought VU and you saw that the price of Apple went up, you can't go, I own VU. Let's go see if I can sell my Apple shares. It doesn't work like that because you actually don't own Apple shares, you own VU shares. So if you're wanting to invest in any of these companies individually, you have to buy or sell that company's individual stock. But if your intention is to buy or sell a share of the fund that follows the index, then that is how you do it. So hopefully this helped kind of clear up what an index is. And if you want to see more about index funds, mutual funds, and ETFs, be sure to subscribe and I will cover that in the next video.